Well, we have seen quite some movements in recent weeks in bond markets, especially in the US, where 10-year treasury yields moved from around 4% beginning of September to almost 5% beginning of October. And this move, interestingly, was not driven by the Federal Reserve. The Fed paused in September. It was not driven by inflation expectations, which were quite stable recently. It was mainly driven by real yields, and real yields reflect positive expectations with regard to growth, and that should not surprise because we have seen quite a string of strong US data in recent weeks. Well, we see quite a discrepancy globally. On the one hand side, we see the US economy doing really well, and on the other hand, we see regions like Europe or China which really struggle. Economically, we see leading indicators really at low levels. There we see the recession actually already imminent in the overall environment. It's not looking good. And against this backdrop, we think there won't be a decoupling or vice versa. We think also the US economy will feel the pain going forward, will feel the pain from higher interest rates. And actually also the US economy is likely to head towards a recession. Looking at recent developments in markets, it's not like kind of a one-way street. It's more like twists and turns. It's a lot coming together. And on top of that, we've seen now that attack of Hamas on Israel. So see the next war and another spike in geopolitical uncertainty. And against this backdrop, we think it's paramount to remain cautious. And we do that by being underweight in equities. We do that by focusing on high-quality bonds, and we do that by diversifying a portfolio beyond equities and beyond bonds by adding gold and insurance-linked securities, for instance, to the portfolio.